On June 17, 1999, the New York Stock Exchange rang with the sound of a $4.5 billion IPO, announcing the birth of Global Crossing, a company that promised to weave a worldwide web of fiber optic cables and reshape the Internet forever. In the glittering glow of the dot-com boom, the firm's founders, former AT&T engineers Gary Winnick and John M. Hunt, sold a vision of unlimited bandwidth, cheap connections, and a new era of global communication. Investors cheered, the stock surged, and the world watched as Global Crossing began laying miles of glass thread across oceans, under continents, and through bustling cities. Within months, the company secured massive contracts with telecom giants, governments, and corporations hungry for the next-generation network. Its flagship project, a transatlantic fiber pair linking New York to London, was hailed as the backbone of the information age. By the end of 1999, Global Crossing boasted more than 300,000 kilometers of fiber, a market valuation exceeding $30 billion, and a place among the elite new economy titans. The press called it the fiber optic empire and compared its rapid ascent to that of a modern renaissance, with every new cable promising untold riches. Yet beneath the glossy press releases, warning signs began to surface. The company's business model relied heavily on capacity-based leasing, where customers paid for reserved bandwidth long before the network was fully operational. Many of those contracts were signed at steep discounts to lock in future revenue, creating a massive book-building strategy that hid the fact that actual cash flow lagged far behind promised earnings. Meanwhile, the cost of laying undersea cable, millions of dollars per kilometer, was soaring, and Global Crossing's aggressive expansion outpaced its ability to monetize the infrastructure. Analysts started to question the sustainability of the build now, sell later approach. In early 2000, the company reported a quarterly loss of $1.1 billion, despite boasting record revenue growth. Critics noted that the losses were being masked by accounting tricks, including the capitalization of operating expenses and the aggressive use of mark-to-market valuations that inflated asset worth on paper. The firm's balance sheet grew increasingly riddled with debt. By the end of 2000, Global Crossing carried more than $20 billion in obligations, much of it in high-interest junk bonds. The warning bells grew louder when, in March 2001, the Federal Communications Commission launched an investigation into Global Crossing's accounting practices. The probe uncovered that the company had booked revenue for long-term contracts before the service was actually delivered, a violation of generally accepted accounting principles. Simultaneously, a whistleblower from within the finance department revealed that senior executives had pressured accountants to smooth earnings, creating a facade of profitability that never existed. Investors, once enamored with the company's promise, began to panic. The stock, which had peaked at $128 per share in early 2000, plummeted below $10 by the summer of 2001. Credit rating agencies downgraded Global Crossing's bonds, raising borrowing costs and triggering a cascade of covenant breaches. The firm's cash reserves evaporated, and it struggled to meet interest payments on its staggering debt load. On January 15, 2002, Global Crossing filed for Chapter 11 bankruptcy protection, marking one of the largest corporate collapses in American history. The filing listed $23 billion in assets and $26 billion in liabilities, a stark illustration of the gulf between the company's lofty aspirations and its financial reality. The bankruptcy court ordered the sale of the company's core assets, including its transatlantic cables, to a consortium of competitors and investors. In a final, bitter twist, the original founders were ousted, and the board was forced to confront the magnitude of the mismanagement that had led to the downfall. The aftermath rippled far beyond the balance sheets. Thousands of employees lost their jobs, and pension funds tied to the company's stock were decimated. Creditors, ranging from small municipal utilities to large institutional investors, faced massive write-offs. The telecom industry as a whole entered a period of consolidation, with surviving carriers absorbing the stranded infrastructure at fire sale prices. The episode also sparked a wave of regulatory reforms, prompting the Securities and Exchange Commission to tighten disclosure requirements for revenue recognition and to increase scrutiny of high-growth tech firms. In the years that followed, the physical network that Global Crossing had built endured, becoming a backbone for newer internet providers, and serving as a reminder that the cables themselves outlived the corporate fantasy that birthed them. Scholars and business schools now study the saga as a cautionary tale of over-optimistic forecasting, aggressive accounting, and the perils of chasing hype at the expense of sound financial discipline. The story of Global Crossing continues to echo in boardrooms, where executives are reminded that building an empire on paper can quickly crumble when reality demands cash. From a dazzling IPO to a monumental bankruptcy in just 3 short years, Global Crossing's rise and fall encapsulates the volatile spirit of the dot-com era, a period where the promise of limitless connectivity collided with the harsh truths of economics. It serves as a stark reminder that in the world of high-tech ambition, even the brightest fiber optic dreams can fray under the weight of unsustainable debt and unchecked optimism. Subscribe to The Collapse for more stories like this.